What's going on, everybody? It's Brody Tennant with Tennant Commercial Group. We're going to talk some 1031 exchanges today. All right, welcome Brenda Muller with 1031 Exchange and Title Expert. All right, Brenda, tell us a little about what you do and a little bit the 1031 process for us.
Hey, Brody, thanks for inviting me. So what I do is consult clients that hold investment real estate property about 1031 tax deferred exchange. My main purpose is to help them understand what a 1031 can do for them when they hold an investment property and they go to sell that property. So the 1031 allows them to defer capital gains tax into another investment property. So my role is strictly teaching them about this part of the Internal Revenue Code that can really benefit them financially.
Yeah, so we kind of work hand in hand with a lot of our buyers and sellers or owning investment real estate. A lot of them will be 1031ing to defer a lot of those taxes. So a lot of what we do commingles with each other. So it's nice to really get an idea of what 1031 exactly is. So if you don't mind, share with us a little bit about what exactly or why you would do a 1031 and the exact benefits of it.
Most people, after they've held an investment property for a period of time, the reason they utilize 1031 is so they can defer those capital gains. They've usually depreciated the property over the course of the period of ownership. And if they've held it for any period of time, when they depreciate that, they end up selling it, and the IRS says, thank you very much. We're glad that you reaped the benefit of the depreciation, and now we want to recapture that back. So the component of the depreciation recapture in itself, a lot of investors aren't even aware of that, and it's 25%. So that's pretty painful if you have held that property for any length of time. So that in itself is kind of a motivation for a lot of people that have held their real estate investment and depreciated it on their taxes. Not to mention the federal capital gains tax, the state tax, and the various components of taxation that they're hit with the following year when they report that sale if they don't use the 1031. So it's mainly, most people want to use the exchange tool, mainly so they can defer that capital gains tax and not have to remit that check. That's pretty painful. Sometimes they use it because they want to diversify their real estate portfolio. They might need cash flow. There's lots of different reasons that people do it. One of the main reasons I think a lot of people do it is they build wealth for their families by way of real estate. It's an awesome tool if you stay in the game. So a lot of people that start exchanging, you'll hear the term swap till you drop, which is kind of funny. But if they stay in the game and they just continue to exchange, let's just say over 30 years of ownership, they build wealth and they continue to exchange, and then they pass away. The heirs to their real estate or their real property, they step up in basis. The heirs suffer no consequence of what they've deferred over those years of exchanging. So most people, when they get in it, they stay in it. They try to set a goal to stay, exchange, and just build wealth by real estate.
It's a very common practice to organically grow your wealth, kind of even through the life of your portfolio. So if you don't mind, could you touch a little bit on the actual tax implications? I know you have a slideshow presented for us. So if you want to share your screen, that'd be great.
Sure. Okay. So on the capital gains tax consequences, this is straightforward, is exactly what it is at this point. So a lot of these taxes, when you get into the individual thresholds, like the first one I already pointed out is the 25% depreciation recapture. And again, most investors, if they're not familiar they're not expecting that. They just don't realize that. If they don't have a good accountant that hasn't communicated to them, hey, by the way, I've been depreciating your property over the course of ownership, but just so you know, if you ever sell this property, you're going to be hit with a 25% depreciation recapture. So I've actually had exchangers call me and say, I did a sale without doing a 1031, and that was terrible, you know. So, and the next component is at the federal capital gains tax. And that's driven by what the income is of the earner, whether it's a single filer or married couples. For the higher ones, it's at the 20%. Anything below the thresholds are 15%. And then we also have the 3.8 net investment income tax, which is also for higher earners. And on the slide there, it shows for single filers, 200,000, married filers, 250. And then the applicable state tax, depending on what state the property is located in. Like in Maryland, we have a 5.75. Virginia has a 5.75. So that's changeable depending on where the real estate's located that they're selling.
Cool.
So I always like to share, Brody, what the code actually says, because people get really hung up on the like kind. So the code is basically no gain or loss shall be recognized on the exchange of real property held for productive use in a trade or business or for investment, if such real property is exchanged solely for real property of like kind, which is to be held either for productive use in a trade or business or for investment. So many people exchange vacant land as well. So it doesn't have to be like a business with fixtures. There are people that exchange vacant land. It doesn't have to have improvements. The recent, in 2017, the Tax Reform Act did modify what the code says, and they added the word real. And the reason for that is they eliminated personal property. They removed personal property. So no longer can people that own, say, for example, commercial property with fixtures or equipment was allowed to be exchanged. No longer. It's strictly real property for real property. So I like to just make it really simple. Real estate for real estate. We're not exchanging personal property anymore as of 2017 when they did the Affordable Care Act. So that's when they reformed the tax in the latter part of 2017. So the like kind, people get hung up on this, and they'll call me and they'll say, you know, Brenda, I know I've got this client, they've got this investment condo down on Miami Beach, and they want to sell it, and I know I need to find them another condo. No. You don't need to find another condo. So the visual here is pretty broad, but I like people to understand. Don't take the like kind in a literal sense. It's basically real estate for real estate, okay? So just keep that in mind. There's a lot of savvy investors that are actually exchanging gas and oil, mineral rights, cell tower easements, air rights in New York. So just keep that in mind. There's some creative things going on right now in the exchange world. So it's not literal, like kind, exact property, okay?
So a lot of the investors are kind of right now is so many people are going from office space or retail and moving to industrial or other facets. That would still be perfectly fine with like kind premise, right?
Absolutely, absolutely. As long as it's held for productive use in a trade or business or simply held for investment, they've accomplished, you know, like kind, real estate for real estate. The main thing to keep in mind, and most commercial, since you're in the commercial space, Brody, most of the folks in the commercial space understand this. Primary residence, second homes, and what they call fix and flips don't qualify for 1031 tax deferred exchange. So let's just get that out of the way. The most popular exchange is the delayed exchange. So I like to let people see the layout of the land on a delayed exchange because the visual seems to be helpful whenever I teach my classes. Time restrictions, 180 days, the full exchange period. First 45, you're required to identify potential replacement property. If you don't identify any potential replacement property on day 46, your exchange is disqualified and all your funds are returned to you. And you're paying your capital gains tax. So that's important that they stay in the identification time parameters. If they don't, they're going to end up paying their capital gains tax. The other real point is these days are calendar days. They run consecutively, holidays, weekends. So just keep that in mind. And then on the 180th day by midnight, if they haven't actually closed on their replacement property, they're on day 181, it's a disqualified exchange. They get all their funds back and they're paying their capital gains tax. So it's pretty straightforward on the time restrictions. And what the QI does is they hold the funds, because in any exchange, the whole point is to limit the taxpayer's access to those funds, because those funds are going to be used to purchase the replacement property. And per the Treasury regulations, they can't have possession of the funds. So that's where the QI comes into play. On the delayed exchange, we request direct deeding, whoever's closing the transaction. So the taxpayer deeds the property to the buyer, and then the funds come into the exchange account that the QI creates to benefit of that taxpayer. And then as they're waiting for them to, find a contract, get their replacement property, and then when they get ready to close on the replacement property, the qualified intermediary works very closely with both the relinquished property closing firm and the replacement property closing firm, because they're moving those funds on behalf of that taxpayer. So
That's
as far
really,
as the exchange,
yeah, go ahead.
go ahead.
So I'd say it's
you had
very
a question?
important in that kind of your timeline when you're planning out doing a 1031 or selling a property in general. You really want to have a game plan of, hey, what does the replacement look like, or is there going to be something of, and a lot of our investors already do this, they do their diligence, what could we replace into and what could our returns be for other property out there. But let's take a look at what actually inventory is out there and already identify a couple before you even list your property is probably a good idea. Just that way that you can have a few lined up as soon as you're under contract on that property. You want to make sure that you have something lined up, because nothing is guaranteed. There might be a couple of deals that aren't there when you're looking to actually sell, or there might be something you find underwriting that just isn't nearly what you thought it was when you were originally looking. So it's always good to have a plethora of different options and opportunities to put into different property, and then narrow it down from there. And then obviously have a great relationship with your QI, so that way you're on top of your timing as well.
Right, and as far as the identification of the properties, there are some specific guidelines and rules that they have to comply with on those identifications. So there's 3 rules and they can only select one. So that's where the QI comes into play as well. I would explain those identification rules, but there are 3. First one's a 3 property rule. The second one is what they call the 200% rule, and the third one's the 95% rule. They're pretty straightforward rules, but depending on if they've already located some properties, we can determine which rule they want to use whenever they're ready to start identifying. But you're absolutely right, Brody. Planning is really paramount. And most people that want to use the 1031, they start looking in advance, even before they've closed on their relinquished property. They're planning forward. They're planning forward. So it's important to try to get a feel of what's going on in the market in the area where you want to replace into as well.
Exactly. Yep, I agree.
So let's just talk really quickly about the exchange equation, because this is kind of important as well. I find that a lot of people, for some reason, I've taught classes in Florida and Alabama and up here in the Mid-Atlantic. I get a lot in the classroom. People think that it's all or nothing with an exchange, and that's not true. If you want to accomplish full tax deferral, that's rather true, but all you have to do is 2 things. You need to reinvest the net exchange proceeds, and then you need to acquire property with the same or greater debt. And if you do that, you've accomplished full tax deferral. You have no boot. So boot in an exchange is anything that the exchanger receives that's considered non-like kind. So the next slide shows you how a client could potentially do a partial exchange if they want to. They absolutely could take some cash the day of closing. So on this one, the client takes $100,000 cash boot. And on the debt that they had they only replaced a portion of the debt in their new property. This example is a partial exchange, and that $140,000 may or may not, more than likely, it's going to trigger a capital gains tax consequence because it does have to be reported. Whenever they report their exchange the following year on the 8824 form, that figure is, given to the IRS, and then based on that taxpayer's personal tax situation the year of the sale, whether they're in a gain or loss, if they have carryover losses, depending on what their personal tax situation is, that $140,000, well, that amount's more than likely going to trigger a tax consequence. I've actually had people, they'll call me and say, Brenda, I've talked to my accountant, we've crunched the numbers, and my accountant's telling me, go ahead and take $20,000 the day of closing because I have some carryover losses, my income's dropped, and my personal tax situation will allow me to take cash, and it's not going to trigger a tax consequence. So every taxpayer needs to talk to their accountant what their personal tax situation is with that particular property. These are some things that you really don't want to do in exchange. You'd be surprised. The very first one is the most important. Closing your relinquished property prior to opening your exchange. The most important thing at the exchange process is to have it opened with a qualified intermediary prior to closing, because you cannot have possessions of the funds or even access to those funds. And people call me all the time, and I'm the one that has to deliver the bad news, that they'll call me and say, hey, Brenda, I closed yesterday, and I've decided I'm going to open an exchange. It's just too late. The ship has sailed. So the most important thing is always, always, always open it prior to closing. And also what I pointed out earlier, you've got to close that replacement. If you close that replacement property after the 180th day, the IRS is going to know because you give them all the information when you report it on the 8824 form. So you don't want to do that. And you need to identify your potential replacement properties within the first 45 days. And again, you don't want to receive the funds. You don't want to go to the closing table. You don't want to touch those funds, because if you touch the funds, you can't do the exchange.
Yep.
Go ahead. Do you have a question?
No, I was just agreeing. And just, it makes you really want to have that conversation and again, planning with your QI beforehand.
Right.
Have these planned
Definitely.
out, Have a
Plan.
Have a
I always
backup
tell
plan
people,
too.
yeah. Whenever people are wanting to do the exchange, it's just paramount that they plan ahead.
Mm-hmm. And ask questions. Don't be afraid to ask questions to the QI about the different types of exchanges, the different ways you can qualify property. I mean, there's all different types of things that some people may just not know. And the only way to find out is to have that conversation.
Absolutely. And Brody, you brought up a good point about different types of exchanges. The one I showed you here today is the delayed exchange. It's the most popular. However, there are other types of exchanges. So we also work with clients that want to do a reverse exchange. And the reverse exchange is just much more complex, a lot more documentation, but it allows the investor to buy the replacement property first. Let's just say they have the property, they know they want it, and they've got to buy it. They have the liquidity or the cash or a lender that's going to allow them or give them the funds to purchase the property. We can actually structure a reverse exchange. We create an entity that acquires that property with the funds that the taxpayer lends to that entity, because the IRS won't allow the taxpayer to be entitled to both properties at the same time, the relinquished and the replacement. So it's really important that if they want to do the reverse, they need to get in touch with the QI well in advance, because it takes a minimum 2 weeks usually to try to structure the reverse exchange, because the QI creates the entity. They file with whatever state that they're creating that entity in. They also manage the entity. So they're much more expensive, much more complex. And I always tell people that the reverse should really be your last option if you can negotiate with the seller of the property you really want and try to maybe put a contingency in the contract that they allow you time for your 1031 transaction to close. There's lots of things, as you well know, Brody, everything's negotiable in most commercial contracts.
Yep.
I was on the phone with a gentleman last week who's going to pay the mortgage on a property that he wants really, really badly to get the seller to wait for his other transaction to close, so he doesn't have to structure that reverse exchange. So I always say go to the reverse exchange as a last resort because they are considerably more expensive to structure, more they're just complex. So I like people to know that right up front.
But sometimes they are necessary. I mean, I've referred to you deals before where the property owner also had his business inside the building, and they couldn't coordinate the way their business was structured. They couldn't coordinate selling that building and buying this one, so they had to go and purchase the building first, and then do a reverse exchange so that they could defer those capital gains. And that's something that Brenda helped them with. But there's different situations for every single person, every single property. So sometimes it's necessary, and sometimes it works out better for your situation. So it's better to have that conversation and figure out exactly what's best for your situation and what goes into that, how you need to prepare, and what you need to do to be ready for that transaction.
Absolutely. One of the other things that I think is really important in any exchange for any client investor is to be comfortable with the security of the funds. And I always say, do your own QI due diligence, because like in any industry, the QI industry, it's not all are created equal. So I like clients to understand that. Also, at the federal level, nobody regulates the qualified intermediary industry, which is quite frightening when you think about how much money people that are acting as QIs are holding. And as I said earlier, there are bad apples in every industry. So this is just some of the things I tell my clients when I consult with them, or when I teach my classes, what they should be asking their QI. I always provide these things to my clients. I partner with Asset Preservation. They do all of the QI services for my clients, and they have all of these types of layers of security. And I think layers of security are important. Segregated accounts are paramount. And, so just make sure, like I always tell people, this is important because your money is being held by them. So you just want to do your due diligence on your client, your qualified intermediary.
Yeah.
So here's some basic steps, just really simple stuff here. But again, planning. I don't think you, Brody, or I have said that maybe enough, but planning is very important. So I always say start with your accountant, your CPA, your tax advisor. That's your first step if you hold an investment property. That way you can determine with your accountant what your true capital gains tax consequence is going to be, and it will help you make a better decision if you want to move in the direction of using the 1031. Consult with a qualified intermediary so you understand how the transaction will flow and what the time restrictions are. That's important. You also want to inform your real estate agent of your intention to perform the 1031. Most of the time in the commercial space, the contracts that attorneys are using, they add the standard exchange language in. If it's a residential property in most states and jurisdictions, that 1031 language is already in a lot of the standard resi contracts. But in the commercial space, the standard exchange language is added into that contract. So you just want to communicate with the real estate agent on that point. I can also send that language out to anybody if they ask for it. And I can't say it enough. I said it earlier. Open the exchange prior to closing. That is the most important thing. Send the fully executed sales contract to the QI to start the process. That's how you as the seller or the investor or the taxpayer, you need to initiate that with the QI. It's not your real estate agent's responsibility. A lot of really good real estate agents will say, have dialogue with their clients, and then they'll just turn them over to me. But the taxpayer is responsible for opening the exchange. And don't ever take actual constructive receipt of the funds. If you have receipt of the funds, the 1031 is blown. So those are the most important steps you want to take.
Yeah, and I'm sure, so that's really good information. And given this time, it's kind of I'm sure a weird time to maybe have this conversation because of COVID. There's been a lot of different things going on in the marketplace, and some businesses are actually thriving, some are not, but there's been less turnover so far. How has the 1031 exchange business been impacted on your end?
Well, on my end, it has slowed. But it's picking up. So it's interesting. In March, the beginning of March was going gangbusters for me. It was actually a start off of a phenomenal month, and then mid-March, everything just stopped. Literally, I think March 16th was a pivotal day for me because everything started canceling. Like some of the deals I had in my pipeline, some of my classes, and then April was just frozen in time. But then I started getting more transactional activity. So I think the investors in the commercial space are impacted the most by this situation with COVID for obvious reasons.
Mm-hmm.
But we're seeing activity with more like single family rentals, smaller units. So people are exchanging. It's just not, for me anyway, in the commercial space. But I do still see commercial activity going on with some of my counterparts and people that I still talk with regularly.
And I think that'll pick up as the banks are starting to not defer their payments, and PPP is starting to slow down. There will be obviously I think a pickup in the commercial real estate space, and there'll be opportunity out there that some investors are capitalized to take advantage of. So I think that we'll start to see things pick up. Unfortunately for some, it's just the properties are not cash flowing that they used to, and it's time to move on to something else, maybe 1031 into something else. All right, Brenda, thank you for a lot of the insightful information with 1031. If anybody has any questions, feel free to reach out to Brenda. What's the best way to contact you?
The best way to contact me, my phone number, give me a call, 540-535-9611, or my email, it's Brenda at Brenda Muller 1031, the letter X, CHANGE.com. Either way, I'm glued to my phone. So if you call me or you email me, you can text me at that number as well.
Great. Yeah, so we'll leave her contact information down below. And if you guys want a copy of that slideshow to go over anything, she'll be happy to send that out to her, to reach out to her via email or cell phone. But again, thank you for coming on, Brenda. That was very insightful.
Sure. Thanks, Brody.
No problem. Have a good day. Talk to you soon.
You too. Take care.
All righty. So thank you again, everybody, for watching. Again, if you have any questions at all about the 1031 process, feel free to reach out to myself or Brenda. I'd be happy to answer some of your questions. But again, don't forget to like, subscribe, and comment anything you want us to touch next week. Otherwise, talk to you guys next time. See ya.